I need to sell 1,000 in MKC and buy 1,000 in MSFT. Yeah, thank you very much. Yeah. Yo, how's it going, everybody? It is me, Mr. Drake, and for the first time this week, after 2 years of careful consideration, I finally dipped my toe in the water of single stock investing. Now, whilst I'll tell you the first two companies I invested in are Tesla and Apple, I will not tell you my reasons why, in case I'm wrong, and I'm also not going to be giving advice or suggestions on what stocks you should or shouldn't be buying. In today's video, we're looking at the circumstances that will help you decide whether investing in stocks is a good or bad idea for you. I will also share a short insight into how you can get into investing. But first, I want to send some big love out to my subscribers. I appreciate all of your support so far, and if you're new, feel free to subscribe and introduce yourself either in the comments or on Insta. I've added a referral link in the descriptions that, if used, will see me and the person who uses the link to register an account given a free randomly selected share to add to their portfolio. But only use this link if A, you think that investing is right for you in your circumstances at the moment, and B, you feel that Trading 212 is the platform that you want to register with. This offer is a loss leader for the 212, which means they may stand to lose money in giving away the free shares, but they make their money back somewhere, and that somewhere is called leverage. Leverage is where you borrow money to invest it, and we never invest using leverage. It can supercharge your profits, but it costs you money, and it can also supercharge your losses. The basics of investing lesson number 1, never invest using leverage. The big fear around investing is losing money, but it's important to realize there are two types of profit and loss in investing: realized and unrealized. If the value of a stock goes up or down from where you bought it, and you haven't yet sold the stock, that profit or loss is known as unrealized returns. At the point that you come to sell the stock, the value that you sell it for relative to the value you bought it becomes your realized return. There's an important lesson to be learned from this. As an investor, investing in companies that you believe will still be going strong a decade from now, you will encounter unrealized losses along the way. But it is only in selling a stock that you will register a profit or loss. So do everything you can to avoid selling stocks for a loss. And finally, investing in stocks and shares can result in you losing your invested capital, so make sure you only invest money that you could afford to lose. This is a concept that I will explain in a little while. We made it through disclaimer season. Let's get stuck into this bad boy. I can hear you out there. You're asking yourself the question, should I start investing? Well, I'm going to read 4 statements out to you, and you're going to know which ones do and don't apply. I spend less than I earn each month. I have at least 3 months' income saved in an account I can easily and freely access in an emergency. If I have debt, the interest rates on my debt are less than 8%. My income is stable, and I don't expect any changes to my income or expenses in the near future. If you said yes to all 4 of those, you passed phase 1. Congratulations! If you said no to any of them, that doesn't rule you out of investing, it just places you at an elevated level of risk. This is because of your income vulnerability affecting your investment strategy. Let me explain. So let's say my name is Rick, or Bob, or Brick. My cash flow is positive by £200 a month, my income is stable, and I'm not intending to spend more or earn less anytime soon. The only problem is I don't have a 3-month savings buffer, and one cold November evening my boiler goes, plunging the house into single-digit temperatures. A new boiler is going to cost me £1,000. That money has got to come from somewhere. So I sell some stocks. But sadly, I'm selling them at a price that's lower than what I bought them for, so I am locking in a loss. What's worse is the next few weeks after I sell those stocks, they go on a massive rally and gain 10% in a few weeks, and I miss out on all of those gains. Don't let that be you. And if you have debts charging you 8% interest, you actually need to earn 10% return on your investments just to keep up with your debt obligations and 2% inflation in the economy. Over the last century, the stock market has averaged returns of 10% annually, and very few people have ever been able to consistently beat the stock market. So what this means is if you have high interest debt, it's going to outpace the return on your investment, so you need to get that high interest debt down to a lower interest rate or get it paid off. It's time now for round 2. I got 4 more statements for you and you'll know if they apply to you. I know what a stock is and that a stock can gain value as well as lose value. My goal is to invest now so that I can enjoy a better quality of life in 10 or more years' time. I am contributing to a workplace or private pension. If my income went down by £150 a month, I'd still be cash flow positive. Once again, 4 yeses and you are flying through.
Congratulations.
Any no's in this instance don't represent an increase in risk, however. They are just things that you could improve to better protect yourself against investment losses. Invest with a long horizon. Realistically speaking, you should only need to make adjustments to your portfolio once, maybe twice per year. Of course, if you're paying in a direct debit, you will make decisions about your direct debit money each month and what investments they go towards, but you shouldn't need to make any major adjustments to your portfolio more than once, maximum twice in a year. A basic level of investing will stop you from making many rookie mistakes. If you were to invest £100 a month and you had a positive cash flow of £100 a month, you could lose all £100 of your invested capital and still not be forced into debt as a result of bad stock performance. This should help take some of the pressure of losses off of you. If you're not contributing to a pension, then that has to become priority number 1 for you. Because when you're too old and frail to work, but the bills have still got to get paid, the state pension will not be enough to help us get by. And don't consider owning a home a retirement plan either, because the only way to get money out of it is by downsizing or putting yourself into debt. You might as well make a bank loan your retirement plan, or hell, even a credit card. If you're interested in investing and you have a private or a workplace pension, your pension is being held in an investment account which you can research and actively manage. Pensions are a super place to have a go at investing and learn the ropes when you're young. Make sure you're contributing to your pension as much as you can, and because the money's tied up until your late 50s or 60s, it is a super safe place to learn the ropes and have a go. If you pass both rounds with 8 yeses, you should be able to invest without any additional risks, knowing that you should be able to recover comfortably from any losses in capital. Whether you're investing in individual stocks, managed or indexed funds, there's still a lot of research that needs to be done into investing, and for a lot of people that can seem like a lot of hard work. So why bother with all the effort of investing? 100%, 1,100%, 23%. These represent 3 different examples of investment returns over 10 years. The first one is a whole world stock market index fund, where you own a teeny tiny piece of everything. If you'd invested £1,000 10 years ago, that £1,000 would now be worth roughly £2,000. The second one is Amazon. If you'd invested £1,000 in Amazon, over 10 years it would be now worth roughly £12,000. And the third one is if you'd invested your £1,000 into a steady and secure savings account, paying 2% interest yearly and compounding. That £1,000 would now be worth roughly £1,230. Of course, this is a completely manipulated example because I could have shown you examples where your money would have lost a lot of value over the 10 years. Like ING Group, for example, where your £1,000 would now be worth £340. And there will always be companies that fall from grace like General Electric, and they are the risk proposition of investing, especially if you buy because of hype or excitement. Like when I bought a small amount of Bitcoin at £6,000 and I sold it at around £18,000. With my profits, I bought Ethereum at £1,200 and it's now at around £250. Individual stock investing offers the most volatile returns because over the course of a decade, you could see 300% profits, 3,000% profits, or even a 90% loss. It's because of this volatility that we need to spend significantly more time monitoring and researching our investments. And we're not just researching the company, the goods, the services, and the management. We also need to consider their marketplace. We need to consider their competition. And we also need to consider the political and economical environment around them and whether that's going to allow them to grow and develop. Doing all of that research doesn't guarantee us positive results though, because we don't know what could happen tomorrow, let alone 5 or 10 years' time. What I will say is doing the research will give you a better chance of being successful. And another way of potentially limiting your losses is to continue to monitor the news around your investments while you're holding them. If you are considering single stock investing, this is where the tire meets the tarmac. Choosing the right investment platform for you is the most important step, because as I said before, you want to invest for the long haul, and potentially having to sell your stocks to change platform in a few years' time could force you into realized losses. Using the cheapest investment platforms isn't always the smartest idea. Many investment platforms offer additional company information as well as investment tools that can help you get an advantage if you learn how to use them effectively. Some of the cheaper or zero commission platforms just allow you a no-frill service that gets you the chance to buy and sell stocks. I chose a zero commission app like Trading 212 because I use the investing.com app to get my news, charts and information and so on. The main fees that you will come across in a platform are fees for buying and selling stocks, annual account fees, fund management fees, and fees for holding a stock for a certain period of time. In a very straw that broke the camel's back type move, platforms will spread their fees out so that none of them on their own look particularly imposing, but when combined together they can drain quite a bit of money from you. It is also worth noting that if you have fees due but you have no money in your available balance on the platform, then the platform will ask you to make funds available. This can be done one of two ways. You can either deposit more money into the platform, or you can sell an asset within the platform and that will put it into your available balance and they can take their slice. Once again, if you're just getting by on your current income, I do not suggest investing for you at this stage, because a development like this could put you in a position where you're forced into either selling an asset or depositing cash, which would leave you down on the month and could force you into an overdraft or a debt situation. Before deciding your platform, have a look to see what offers the best balance of great customer service and affordable charges. Some companies will charge a fixed rate and others will charge a percentage. It is likely that if you're investing anything less than £10,000, the percentage charges are going to work out cheaper than the fixed rate charges. You know what? I hear you. You want to invest, but you don't want to spend any time doing research or doing any work. Well, maybe set it and forget it robo-investors could be your salvation. It's all in the title. You set the deposit amount and the robo-investor does the rest. It allocates your funds based on a questionnaire that you fill in when you register. The only problem with this is, I trust robo-investors about as much as children, in that the second you take your eyes off of them, you don't know what they could be doing. It could be a tough few years to be investing in individual stocks and certain types of funds, with many of the largest economies around the world on the edge. China and America are affected by trade tensions, Brexit is affecting the EU and the UK, and Italy's financial troubles are further affecting the EU. As well as rising national debt in many major countries, the robo-advisor will always take their cut, but we have no idea what they're invested in and whether they're asleep at the wheel. The set it and forget it strategy may work best for you, but I would suggest maybe keep an eye on it now and then to make sure that it's not throwing you off the edge of a cliff. And always, as always, pay attention to the fees. In next week's video, I'm going to be talking about index funds. If single stock investments are the sports car of the investment world, high-powered, glamorous, but likely to throw you out your chair if you're not careful, index funds are the workhorse. They're not going to offer you 1,000% returns in 10 years, but what they will do is provide a massive boost to your portfolio if trusted in the long run. Until next week, stay cash flow strong, turn your wages into wealth. Have a lovely week, guys. I will see you soon.